And I got to get that thing out of the way. There. Now I'm ready. You got your coffee? Hang on. Let me have a cup of espresso. Man, that's good. All right. Hey, welcome to Forex.Today, the YouTube community of more than 20,000 foreign exchange traders. We gather here today to conduct technical and fundamental analysis with the overriding goal of planning our trades in advance. Let me remind you that trading is risky, not appropriate for everyone. Your past performance, good or bad, is not necessarily indicative of future results. Please stay small, stay humble, focus on the long term. Never risk money you cannot afford to lose. Hope says what? You joined the group yesterday. Yeah. And yeah, no, we did it for sure. You went into the day trading group. See, there's the day trading group and the swing trading group. So you have to go into the day trading group room at FX Bootcamp, and then from there. By the way, I got my, or is it this way? No, this way. Look at that. Oh, you can't see him. Hang on. He's upside down. He's upside down. He's upside down. Let's see. Now can you see him? He's a bull. There we go. Can't. There you go. See that? He's a bull. There we go. Yeah, he's a bull. Yeah. What about the other side? Dollar. Yeah, dollar. Got dollar on the other side. Anyways. Anywho. So hopefully today is going to be a good day. What do you think? Hopefully today is going to be a good day. So we will go through the pairs. I suppose we'll go through dollar pairs. Maybe take a look at some of the yen pairs. Look at gold, oil, and Bitcoin. Take a look at ADP. Right? Well, okay. Hope says what? I went to the FX Bootcamp swing trading menu, right, which does not meet 4 p.m. on Tuesdays. So I have to go to day trading. Yes. Because day traders meet every day, swing traders meet twice a week. I don't think that's that confusing, but okay. Anywho, I'm just reading in the chat, just so you know. All right, so look, in the description below, there's a link to my book. Check it out. There's a link to FX Bootcamp. Check it out. There's a link to Trader's Way. An ECN, straight through processing. Execute your trades almost instantaneously into the liquidity pool of the interbanking system. They don't mess around with your trades. They don't trade against you. If you like that idea, open up an ECN account at tradersway.com. Okay. Here we go. Let me get some more coffee into me. Can I look at Aussie versus US dollar and Euro versus US dollar? Yeah, I can definitely do that. Let's move over to see what's happening today first, and then while that loads, nope. Nope. Man, I got too many things open. No. Maybe got stuck on Dave Matthews Band page. Yeah, it did. How funny is that? All right, cool. Taking a look here, ADP, 127,000. Okay. I hope I sent out an email saying that Ryan's session on Tuesday got rescheduled for personal reasons. So they're happening today. So maybe that's what you're talking about. But yes, the swing trading group meets Tuesdays at 2 p.m., not 4 p.m., 2 p.m. Okay. And then the swing trading is at 4 p.m. on Thursdays. But yesterday there was an issue, so I sent out an email. It was rescheduled. It's going to happen today. All right. So check this out. Wages are way up. Wowzer. And are we in a recession yet? Well, you might say, "Oh my God, that was supposed to be $250,000 or 250,000 jobs or something," because that's what people are thinking about for non-farm payrolls, which may or may not be true. But the thing is, 127,000 more people have jobs. Doesn't feel like we're going to set up, soup kitchens for the unemployment quite yet, huh? We're not losing jobs or adding jobs. Amazing, huh? So yeah, maybe it's growing less quickly, but the economy is still growing in that case. Okay. So anyways, that's pretty amazing. Now, some people will say this is going to mean something about NFP. Not necessarily. So if you want to take a look at the greater details of this, let me share that with you. Okay, that's it. I'm still reading Hope's thing. No, I did not meet with swing traders. I met with day traders. Ryan meets with swing traders on Tuesdays, but that was rescheduled. Okay. How many basis points do you think the Fed will raise the rate by? Who cares? That's my facetious response. But the market is pricing in 50 basis points, but does it matter? They're still trying to figure out things like the terminal rate. But look, like what I think doesn't matter. Okay, so you just look. It doesn't matter what I think. You just look. You just get the information. Okay. So we're at 4, let's say. Okay, we're at 4. And 67.5% of the market says 450. Oh, my pleasure, Hope. So you see why my answer is facetious, trucking mogul? Who the heck cares what I think? My opinion is irrelevant. Okay? So quantitatively speaking, you just gather the data. There's a 33% chance of 75 basis points. Who comes up with this? This is smart money negotiating hundreds of billions of dollars in deals. So, like, I haven't negotiated hundreds of billions of dollars worth of deals with institutional investors. So, but these guys have. Cool. So that's the fact. Right? So, trucking mogul, I want you to walk around with swagger. And you're like, you get to drop things like, hey, did you know there's a 68% chance that the Fed's going to only raise by 50 basis points in December? Right? And it's fact. It's fact. You don't need anyone else's opinion. I actually explained this in the FX Street interview that I did over the holidays. Yes, over the holidays with my mommy sitting in the dining room playing cards with my family, my wife and kids. I was outside writing an article for FX Street. Okay? And one of the things I say is a reporter will report this number. That's where they get the number when they say, well, there's a 67.5% chance the Fed's only going to raise by 50 basis points. Okay, great. But that's still amateur hour, in my opinion. What I'm interested in is like, let's look 1 year out. I guess we'll do it here. 1 year out. And I like to see this dynamically, how it changes. Okay, it changes. Blah, 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 blah. And that's what the smart money pays attention to. If it's moving to the right, the dollar's strong. If it's moving to the left, the dollar's weak. And what do you mean? Well, this seems to be a normal distribution. Okay? But what you'll see is there's more on this side than that side. Okay? And so this can move up and this can move down and vice versa. And as it moves further to the right, which means higher terminal rate, the stronger the dollar gets. Okay? The more it moves to the left. So in this case, like time might go by and we go from here or we go from here. So let's say, for example, 2 weeks from now, this is the center of the distribution. So we went from here to here, and if that's the case, the dollar would probably weaken. Oh my God. Oh my God. Oh my God. Huh? Oh, thank you, Denise. Sometimes I'm a bit blunt. Okay, so anyways, look at that. Now you're smarter than probably 8% of traders. Just knowing something like that. Right, trucking mogul? Okay. So I've only been using this tool for 20 years. But yeah, there you go. Compliments of the firm. Hey, can I get a thumbs up for that? That's helpful. That gets you closer and closer to smart money. Okay? Now, in my opinion, this is wrong. I'm in this camp right now. But I said that a year ago, 9 months ago. Back when they were still thinking this was the terminal rate. Okay? I mean, you forget that the average age on Wall Street dictates that your average professional started their job probably around 2008 after the financial crisis. And they don't remember the Fed funds rate, okay, which is what we're measuring here. They don't remember 2000 and let's say 6. I'm going to guess at that point the Fed funds rate was at 5.25%. The thing is, the professionals, many of people in Wall Street, were not trading then. They were playing high school football. Right? Or making out under the bleachers. They don't remember when the Fed funds rate was 5.25. So they spent their whole career with the Fed's fund rate at 0, and they can't imagine the Fed funds rate at this level. But if you have gray hair, you do. You're like, shoot, there was no crisis. The world was great, right as rain. This is normal. Okay? This is normal. So when I see like people pushing back like, we just can't push the Fed funds futures rate to 5.25, it'll be the end of the world. Well, maybe it would be, but probably not. Probably not. So that's my perspective. That would be normal. Yeah. Okay, you know what's normal? What's normal is inflation is 2.2%. Well, how did we get significantly higher than that? We gave money away for free. We gave crack, and now everyone's a crack addict. Is that normal? No. So normal would be inflation, right? 2.2. Or I should say growth. Let me change this one. Let's say GDP. I'm going to make this GDP. GDP. Let's make inflation. I'm going to make inflation 1.7. I'm going to make S&P 500 8%. So therefore, we'll make the yield on the 10-year 3.8%. And in this world, a portfolio of 60% stocks, 40% bonds probably works. That model hasn't worked since 2008. So can we get there? I don't think we can get here for a very long time. Unless we have a very severe global economic downturn where some countries go into depression. Okay? But now what's interesting is the 60-40 might actually be working again. And that's why you see, I don't know if you're paying attention to the yield curve and the spread in the curve. I don't know if you pay attention to that stuff. But what it's showing is people are starting to build, and I should say more institutions, not people, but institutions are starting to go back to a 60, well, I don't know about 60-40, but there are lots of people that locked in a 10-year T note and even a 2-year note well above 4%. Okay, the 10-year went to, I think, 4.4, and the 2-year went to 4.8. And investors bought it. Which is their way of saying in the 10-year period, inflation's going to fall. From 8 something back closer to this, but I think the number is going to be like 3.7% inflation. Okay? And do you think it's good to have inflation above GDP? See, now when I ask you a question like that, it's the whole point of macroeconomics. So once you start to understand macroeconomics, you start to get it. The market tells you that inflation is going to be high for the next, let's say, 3 or 4 years, but in 5 or 6 years, inflation will come down. That information is freely available and made by people's decision on investing, not by a survey. What do you think? That's showing you how people are putting their money together. How they're investing their money with decisions they're making, and therefore that's how we read the market. And all that information's there. It's just that 98, maybe 99% of people have no clue. I would highly recommend you do the macroeconomics course at FX Bootcamp. Okay? A similar class at Harvard would cost you, what is it per class? $5,000? Probably more. But I'll just say $5,000. You can go to Harvard, take one class on macroeconomics. It's going to be minimum $5,000. And then you're going to have to probably spend another $500 on textbooks. Or you can pay $88 a year at FX Bootcamp, take the macroeconomics course and the monetary policy course. And now you have the equivalent of 2 Harvard classes on economics. So you get $10,000. All right? Plus the books. So $11,000 worth of value. And it's $88 a year. Or go ahead and just continue to not know. It's your choice. Huh? Now I'm being pissy. Well, I apologize. All right. Let's take let's step back. Let's step back a little bit. Add some more time here. Morning, Mattis. How is Florida? I heard you and Maida got drunk and got matching tattoos. Is that true? I love Forex. Wait, you guys went for cigars? No. Yeah, and many authentic mojitos. Very cool. All right, so anywho, by the way, thank you, Florida, for all the rain you've sent recently. Holy smokes, did it rain last night here in Georgia. Oh, warm weather, but holy smokes, did it rain, like buckets of rain last night. Oh, Manus, vegetarian Cuban food is easy. Black beans and rice. Maida went for cigars and smoked one too. That is amazing. That is so cool. That is so cool. Very cool. Very, very cool. I'm so happy for you guys. You make me happy. Your happiness makes me happy. That's so cool. All right, so taking a step back here. Okay, one thing that stands out is you probably should be selling kitty cat. Okay. What else is going on? Okay. Dollar's still not strong. Okay. Now look at this. This is longer term. I want you to know that. This is longer term. Kiwi is longer term strong. Aussie is, well, it's still in an up move. You can see it came to the bottom of my channel. Remember, this is not Aussie versus dollar like the chart says. It's Aussie versus everything. So it's wonderful how the channel's working, huh? Pound is, well, no longer following the channel. That might be the new news. Okay, so if it makes a higher high, we got a trend there. Okay, Swissy all over the place. This still looks more down than up. Okay. And one of the things I was looking at last night in the day trading group at 4 p.m., the day trading group, okay, is yen weakness, which means if I think this is coming down, I buy all the yen pairs. Okay. And then this still looks quite weak, and seasonality says that this can stay weak for a while. But I'd love to kind of see this kind of start to roll back over into strength. But I think it'll take 5 weeks to do it. Okay. Well, Lewis, the whole point of doing macroeconomics is to pay attention to changes in policy at the central bank. And then as traders, comparing the economies to each other, contrasting and comparing economies. So anyways, so you probably want to pick on Kitty Cat and Kiwi. And this is something we did back on Sunday night. So like we could go in here. Okay. Where's the Kiwi one? Oh. Okay. Okay. And now we're in the zone. Now it's scary that we have not made a higher high. So that one you got to be careful with. You might want to just look at it at a higher time frame. Okay. And what do you think a bull would do? Okay. Okay. Now the problem with this is that's where the 21 is now, but it won't be there in the future. So your job is to think forward. Okay. And trade where it's going to be in the future. But it still gets you the same scenario of somewhere in here is your giddy up zone. Giddy up. Okay. Now I like to use role reversals. But there are many ways to skin this rabbit. But nonetheless, okay, when you're here, what you want to do is buy a dip. Okay? You don't buy high if you're a trader. You only buy low if you're a trader. So how do you define low? I like to look at the previous high and drag it across. And that gives me my buy zone. By the way, you might have been taught somewhere in your trading career that you should buy a breakout. And then you wonder why you either don't make a lot of money because you get kicked out here, or you seem to like get knocked out at break even, and then it takes off. Whoever taught you to trade a breakout doesn't know what the heck they're doing. But it sells a lot of books and training courses. That's right, Manus. Smoking a cigar is the vegetarian version of smoking cigarettes. You can chew on a steak, you just can't swallow it. Or it will make you really, really sick. So anywho, the way you trade a breakout is to have it come all the way back. And the interesting thing, and I remember I'm self-taught, so I figured this out. And I figured this out through pain. In my early days of trading, I found that I could figure this part of the trade out. Okay? But I found that I entered most of my trades up in here somewhere. And so I got in this habit of buying, and then I'd wait, and I'm profitable for a while, and then I'm losing money for a while, and then I'm profitable for a while, and then I'm giving some back for a while, and then, you know, like a million years later, I start to make money. And I hated it. I hated it. I hated this period in here of slightly profitable and then negative and then break even and then negative and then break even and then positive and then break even. And I spent a lot of time going through pain. And I mean like literally physical pain, like upset stomach type pain. So after, quite a bit of time, I realized that I needed to let it break in the direction of my predicted move, which is my bias, right? And then not trade it. Not trade it. And wait for that pullback, because I knew every time I bought, I would be profitable for a while, but then I would lose money for a while. That dreaded negative 30 or negative 20. Okay? That kind of stuff. So I thought, you know what? I'm going to wait until I want to buy. And then I'm going to wait for it to drop, let's say, 25 pips. Do you understand? That's how I got to the methodology I'm at now. Pain and suffering. And so now it's pretty on the chart, because I say as soon as you got the higher high, let it fall and buy it, and you're going to end up buying it somewhere around here. Okay? So let's go back to that. Nice. Okay, new higher high. Nice. There's your buy. Okay, new higher high. Drag this across. There's your buy. New higher high. Drag this across. There's your buy. See? I'll just grab right there. Isn't that awesome? See you, Elmo. Armoro Picasso. Wait, that's yesterday's copy. Oh, well. Hey, can I get some love for that? Will you click the like button? That's got to be an eye-opener for newer traders. That's right. That's legit. There are people here that have spent thousands of dollars on Forex training courses and never got that level of value. But, no love. No one wants to click the like button. All right, fine. I'll keep it simple then. Wayne, just tell me what to do. I don't care. Okay. Well, there's other trades here. Great. Let's look at gold, oil, and Bitcoin. Okay. Oy vey, look at this one. So we had a breakout here on oil, and one of the discussions we had last night is this was a great place to be a bear. And I said, but you might be in a scenario where you're like, but what if it pops up? Well, if it pops up, you'll take a small loss. But it'll also be technically meaningful. Okay, technically meaningful. So now, based on this break of a trend, you should be careful as a bear. And bulls, you need to be careful at the next roll reversal, because we're looking at this on an hourly chart. But if I looked at this on a 4-hour or daily, let's see if it'll work on a 4-hour. Okay. You can see that there's something going on here, right? And December pivot points have already picked that up. Now, I already have everything drawn here for you because nothing's really changed over the last 2 months, 3 months? So this is where we are right now. That's it. So you really need to decide what you want to do here, right? Well, Charles, which economic data? Yeah, well, 5 years is patience, huh? Charlie says GDP and ADP. It didn't change anything. Nothing's changed. GDP hasn't changed the Fed's outlook. ADP hasn't changed the Fed's outlook. The one thing that might have changed the Fed's outlook or allowed them to make let's say the reduction at the rate of increases was more like CPI, almost a month ago, right? 2 or 3 weeks ago. Okay. But you have to realize news is not really that important to the Fed. That's why, those that focus on trading the news, that's a volatility trade. The Fed doesn't give a crap about the volatility. Okay. That's a short-term opportunity when sort of markets have to adjust quickly or something, right? So the Fed is interested in the trend in economic data. Okay? The trend in economic data. So if I move over here and pick on like euro dollar, okay, what they're doing is similar to what I'm doing here. Oops. Let's change this to, I guess baby blue will stand out. Okay. We're looking at growth and inflation. Okay. We're looking at levels of unemployment. We're looking at interest rates. Okay. This is what the Fed is looking at to make their decisions. Now, we're using here CPI. The Fed is using PCE. But they're not just looking at these numbers, they're looking at the trends. Okay, so inflation is coming down. Okay? And that's what matters. So ADP, absolutely worthless. There's nothing interesting about the ADP report. It doesn't predict non-farm payrolls. The Fed doesn't watch it. Okay, so nothing there. And GDP, the problem with GDP, okay, Charles? Charlie? Chuck? The problem with GDP is it's backward looking. Right, but that would be somewhat true. I think what you're seeing there, and I would agree with it, Charles, is that the market doesn't have it priced in correctly. I think a lot of institutional investors are simply wrong. But would it be because of GDP? No, GDP is backward looking. And right, but GDP is not collapsing either. But it's too far back for the Fed to really care about that. the one thing that they're focused on right now is inflation. So I would say GDP will tell you 6 months late, right, that a recession has started. Right? Like it's not going to tell the Fed what to do. It tells the Fed what has already happened, but they don't care what's already happened 6 months ago or 3 months ago. Okay? So the next thing is, well, what gets updated every month? What has a higher frequency than GDP? PCE or CPI. So inflation's way too high, but it is starting to moderate. So that's where you get the idea, Charles, of the Fed's still going to raise interest rates. We don't know what the terminal rate is, but they do have permission to slow the pace. Now, why do we assume they're going to slow the pace? Well, A, inflation is slowing and coming down from 8 something now down to 7 something. But in the meeting minutes and in the press conference after the last Fed meeting, Jay Powell talked about the cumulative effects of previous rate hikes, which tells you, Charles, that they want a window open to slow the rate in which they raise interest rates. The rate of change is going to slow. They're going to still raise interest rates, but not necessarily at 75 basis points anymore. Aha! So all that is set. You understand? So now GDP is something that's so backward looking that the Fed doesn't care. And they're not worried about growth. They're worried about inflation. So you asked about GDP. They don't care. So I don't really care. Then you asked about ADP. ADP, they don't even track it. They look at their government reports. Now, look, obviously they're not dumb and they don't have invisible eyes or minds, right? So they see it, but they're much more interested in non-farm payrolls. But they're also very interested in the subcomponents. They're also didn't JOLTS just come out? No, JOLTS is coming out very shortly. So they're much more interested in JOLTS. They're much more interested in NFP. So are they going to look at ADP? Yeah. Are they going to admit that publicly? No. Does it get put into their models? No. But it is informative information. But your question was specific. What does all this information mean about what Powell's going to say today? Nothing. Okay? But I like your logic, though. Your logic is fine. GDP is good for now. Yeah. Job growth remains. Yes. Okay? But more importantly, is it job growth? What if everybody continue, what if jobs stayed above 100,000 every month? So they're much lower than before. Okay? But let's say it stayed positive. We never go negative. However, wages start falling. Aha, ha, ha, ha. Okay? So going back to the ADP report, I think the only thing that matters to me out of that ADP were the high wages. And what that says is the Fed is going to, they're going to continue raising interest rates to a higher terminal rate than what's being priced in. And that tells me in the next 5 weeks, I'm almost certainly buying the US dollar. Okay? So yes, higher rates, Charles, but it'll take longer to get there. So 5 1/4, 5 1/2, 5 3/4, none of that's really priced in. And I already explained how to verify whether it's priced in or not. And I've also verified how when those numbers change, how to position your portfolio. I already explained that today, so I won't do it again. Okay. Charles says, well, that's what I'm looking for. Well, yeah, but, right? They will hike 75 basis points. Yeah, but there's a 100% chance of that. So that's not relevant information. But you can say there's a 67.5% chance that it's only 50 basis points. Okay? And I would agree with that because I understand why they think that. Okay, 67.5% chance of a 50 basis point hike. So I already know that. But we already, look, at boot camp, we've talked about this months ago. So, like, none of that is new. Okay? But that's already been priced in. That's already done. Like, how do we get to this number? They've already made those investments. That's why I don't even think it's relevant anymore. It would only be relevant if we get to the Fed meeting and this is wrong. The Fed jacks it up by 75 basis points. Okay? Otherwise, it doesn't matter because the way that this number is derived is through investments already made. That's why it's priced in. They already priced it. They already did the deal. These are contracts negotiated bank to bank. So it's only relevant if the Fed comes out and it turns out December 14th, it's 75 basis points. Holy crap, the dollar would get strong. Why? Because we haven't priced that in. It would have to be priced in. So what's the bigger question? Where are we going to be 12 months from now? And obviously nobody knows. So there's more inefficiency with that. If you do your analysis correct, it's whoever can price the terminal rate closest that will win. And right now, it's gone from 3.75 to 4.25 to 4.5. Now 5% is getting priced in. But at least 6 months ago, probably longer than that, I was saying 5.25 when the market was talking 4. I'm like, 4? Why not 5.25? Why not 5.5? And that's what we do. This is what's reported by someone with a journalism major from a liberal arts school. Okay? And this is where the money is made. This is where the conversation on Wall Street is. We already know the top one. So that's why you're like, well, what about ADP that came out today? How's that going to affect the Fed? What are you talking about? Nobody cares. It's done. And that's so then you're like, well, why does the market move? That's volatility. And in the article I wrote for FX Street over the holidays, volatility is bad. So amateur traders try to trade the volatility and institutional traders avoid the volatility. So it's retail traders trading against retail traders, and maybe some smart money goes in there just to whack-a-mole a little bit, right? Push the retail traders around, make a quick buck, and have a laugh. But the real money's made on the bottom question. Where's that going to be? And we don't agree. And that's where the inefficiency is. And inefficiency allows you to create and extract alpha, value. Okay? And when the market is wrong, so like the Fed ignores the market and the Fed does something different, you get extra volatility, and it probably lasts a little bit longer because everyone that's trying to position here on the bottom part will say they got this wrong, so their bottom one is wrong too, right? You understand that? If you get the top part wrong, then the bottom part's wrong. Because you're like, let's say we're talking about a hedge fund, and the hedge fund's like, okay, we got this priced in, great. So based on this in our model, we slow down to 50 basis points. So let me get that down. Okay. We drop down to 50 basis points, and then right, and that gets us to 4.5. And then we drop down to 25. We do 2 more of those, and that gets us to 5, and we stop. That's what's been priced in now. But what if they raise 75 basis points? Oh my God. Then this, whatever they assumed, so they were assuming 5 on this, well then their assumption here is wrong. So you'd have to update your model. 75 basis points here means what? Not 5, 5.25. But if you got this top part wrong and it's still 75 basis points, well then, is the next one after that going to be 75 basis point too? Or is that one then 50? Like, how wrong are you here? So it might be 5.25. It might be 5.5. Okay. And this is where everyone's sort of in this sort of panic mode. It's not that right? There's like a cascade going on of if you get the current decision wrong, how bad is the terminal rate discussion in your model wrong? And you might have to start pricing in not just even a 25 basis points different, 50 or 75 basis points different in the future. US dollar gets ripper strong. Now, then you got to take that terminal number. So let's say now you got to update all the way to 5.5, 5.5 terminal rate. Okay, so now you got to make some choices when it comes to the stock market. Right? So you can do like the expected return of a stock, right, is equal to what? 5.5 okay, plus the beta, okay. What's that? What's after that? I think it's the market. So the expected return for the S&P 500. So expected return for the market minus 5.5%. Because that's your opportunity cost. Okay. Now, if the old number was 5 or even 4.5, that means this risk-free rate of return has gone up. So we'll remove the variable, okay, and just put in the idea that okay, the risk-free rate of return is going up. The risk-free come on now. Risk-free rate of return is going up. So what does the math dictate? The stock market's going to fall. Well, in this case, the value of a stock's going to fall. But this is, right, we're trading the market. So we're actually trying to reverse engineer the expected return of the market, but we're doing it per stock. You have to understand the higher this goes, the less an individual stock is likely to return. Or, right? Or you get this, what the present value of the S&P 500, for example, is equal to the future cash flows of the S&P 500 stocks over 1 plus, okay, we'll put that 5.5, for example. Actually, you have to do it as decimal, of course, times 0.055 over the period. Oops, that should be N, sorry. Over the period. So if you thought if you're trying to calculate based on expected cash flows over the next 3 years, you'd get this present value. But the thing is, as this variable here is rising, so the old model was 3.75. Then they had to adjust the model. It's going to be 4.25. Then they're adjusting the model again. Now they expect this in 1 year from now to be 5%. They might have to adjust that model again to all the way up to 5.5%. But as they're raising this variable, as that variable rises, which is what we're talking about, the terminal rate of the Fed funds futures market, aka the interest rate in the United States, then the value of the S&P 500 falls. Just like the value of every individual stock falls, the market falls. Okay? And we're not even talking about demand destruction. That's if cash flows stay the same. So if next year companies have less cash flows, then the S&P 500 falls even more. Not because interest rates are higher, but because we're in recession. You see? So anyways, going back to Charles' question, well, what about ADP and GDP? How does that affect the Fed? Nobody cares. That's why, my instant answer is you're asking, I like your thought process of GDP is good, job growth remains, consumer sentiment is still rising. Yeah, but they're the wrong questions. They're smart and they're relevant, but no. That's no. It's not enough. Okay. Right? It's not enough when someone says, well, consumer sentiment is good. It's, let's say it's logical, but it's weak logic. Again, it's really good at a newspaper level, economic analysis, but as far as a hedge fund, no one has ever said to me, oh, but look at consumer sentiment. Right? No. A fund is thinking a year in advance. Another way of looking at it is George Soros needs an entire year, right? George Soros needs an entire year just to build his position. Which means he's thinking 5 years in advance. So you should ask George Soros when he's doing that, hey, what do you think about consumer sentiment? You're like, right? So that the questions are really, what's the terminal rate? Because imagine now you're a stock investor. You're a hedge fund and all you do is buy stocks. Long only stock fund manager, right? What are you doing right now? You're doing the two models I just showed you to try to calculate the value of a company and whether it's undervalued or not. Okay? And so we have 50 basis points priced in. 67.5% of all Fed funds futures contracts are priced in with a 50 basis points rate hike. Okay? Not all of them, 2/3. So you put that into your model. And then you look into the future. What about the next Fed meeting? What about the next Fed meeting? See, I can do this. All right, like there's literally an analyst. There's probably hundreds of analysts in Wall Street all doing the exact same thing. Let me bring it back up. Okay, let me bring this back up. Okay, you put these numbers in. Okay, so let's say you do the majority here. Okay, the majority. You put that number in your model. What about the February meeting? Okay, put that in your model. What about the March meeting? Put that in your model. What about the May meeting? Put that in your model. What about the June meeting? Put that into your model. See, in June, the market believes interest rates are going to be between 5 and 5.25. What about the July meeting? Look at that. Look at it. The market doesn't believe we're going higher than 5.25. You see? See how smart you are? See, in February, they're going to raise interest rates. And in March, they're not going to raise interest rates. And in May, they're not going to raise interest rates. And in June, they're not going to raise interest rates. In July, they're not going to raise interest rates. And in September, they're not going to raise interest rates. In November, they're going to cut interest rates in November. Come on. That doesn't impress you? December, they're going to cut interest rates? You don't find that impressive? You won't click the thumbs up button for that? I'm telling you, nobody knows this stuff. Except, well, hedge fund managers. This is what they do all day. This is what Wall Street people do all day. What about consumer sentiment? What? What? Well, what about consumer sentiment? You're like, what are you talking about? Who cares? Right? So anyways, I'm having fun. I'm not picking on you, Charles, but you're bringing up points. But like, you asked me right away, what do I think about that stuff? I'm like, I don't think about that stuff at all. Why is that even relevant, right? Join FX Bootcamp. Join FX Bootcamp. You gotta know this stuff. Okay. You found it, man. This everything you're looking for. Okay. All right, let's move on. Great question. Thank you for that. Okay, what's the stock market going to do now? Kick right off the moving average. Ba-doop, ba-doop, ba-doop. We talked about this a day or two ago in the day trading group. Hey. I think Darko asked a question about volume, or that's what we were discussing, anyways. So, anywho, okay, the stock market again kind of come down, and it's trying to test our next level. Okay, you see right in here, a drop below that is significant. It's going up on the open, maybe. Okay, but price action, right? Like, look at this. So you have to do it this way. Top, and then you got to mark out roll reversal. Right? Well, that's why the old top is like, let me get rid of this. That's what this sell is all about. This one here. Very, very simple trade. Down, 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 up, up, sell. Already covered price action earlier. So that's done. Remember what I taught you earlier? Then you get a lower low. So what do? You go back to the old lower high, and your trade plan looks like this. And it either falls or you're going to take a small loss. Yeah, well, welcome to the world. What are you going to make 5 trades today? Okay. Now, what do you think? Okay. You see, it's even labeled continuation. Okay. What does this mean? Probably gold down. Well, I already have it all set up for that. Look at it on a smaller time frame, maybe. And there she go. There she go. There she blow. So you do something like that. Probably, where would you mark this bottom? Somewhere in this zone, right? And you're like, well, I don't know where to draw it. Just use Fibonacci, right? Okay, what you do is, as this falls, you keep adjusting Fibonacci. And then once it starts green candling, then you leave it. That's where it is currently. Okay, you just pull it down until it, I mean, let's assume you don't know how to do that. What could I do? I could insert indicator. What would be trend, PSR? No. Can I add their volume? No. I could add fractals. Where's fractals on this stuff? Shapes, no. Fractals, expansion. It's amazing that people put the MetaTraders or MetaQuotes puts all this stuff here, and nobody knows anything about how to use it. I don't think anybody uses, right? I think almost all of this is irrelevant. Nobody uses it. But it's included. We need to put a fractal on here is what I'm getting at. So do I have a fractal? I probably deleted all my fractals. That's correct. And I just showed you month after month after month which ones are being priced in for that. Do I have fractals? I mean, I saw a couple down there, but I want the basic fractal that everybody has. But I think I've deleted them all. Market, facilitation, index, volumes, oscillators. Wouldn't be in there. No. Trend. Anyways, I was going to pop in a fractal. I think I've deleted all my fractals. It's just nothing I would use. Huh. Well, good, I guess. Unless I'm just right. No. I'll look again. No. 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 Oh, there's Bill Williams fractals. Let's try these. Yellow would be a dumb color, but we'll do... I guess we'll do black or dark blue. It will stand out a little bit. Okay, there you go. So that you don't show direction. That's just a dumb... I wouldn't have made that. Anyways, it's just showing turning points. You have to look at it like it's only drawing like a cup. Although it did 2 cups up. I don't know. It's not my indicator. But if it drew one here, then you would stop dragging your fib. Okay? And then you would look to sell somewhere in here. And I think waiting for the turn to sell, like waiting for the cup or whatever you want to call it, the fractal, to show up, I think it's too slow because by the time it shows up, it's probably down here. So you have to understand that these price levels in the fib are predictive and the moving averages on this time frame are predictive. So you'd probably like sell on the ribbon, sell in the zone if this ends up being the bottom. Now, if it keeps falling, you just keep dragging this until it goes up. But you see how slow that is and how much work that is? So I'd rather just delete that, delete the fib, delete these fractals because they're stupid. Oh, but thank you, MetaQuotes, for including them. And what should we use? Well, we have a set of lagging indicators, and we have a leading indicator. And they'll probably converge. So this is the leading. And this is the lagging. And that's how you'd use that. Okay. So you would see if we make the lower low, and you can see I've marked all this up, what, a week ago? Week and a half ago? Okay. If it breaks the, right, so this is the potential lower high off the old roll reversal. If it does this, and that's what you're doing on a smaller time frame, then you probably have something pretty powerful going on. What this is also showing is the bulls live down here. So, do you? You do you. You're going to ask a question like, well, which one's right? Wrong question. Which one of these time frames is right? Well, they're both right. They're algorithms. The math is perfect. So which one do you choose? Different question. Are you trading the daily chart or are you trading the 1 hour chart? Well, that's your decision. But they're both correct. So how are you going to make a decision? Macroeconomics. So you could, if you were patient and disciplined, you could wait for the lower low, lower high, and then sell. Just like here. Okay? Down, 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 up, up, sell, down, 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 up, sell, down, 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 up, sell, down, 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 down. Oh, no lower low. Oh, triple bottom. Look. This is the beginning of the second quarter. Right? This is, let me get rid of this. I mean, let me try to get this as close as I could possibly get. You see? What is, so this is within a day or two or three. Let's say this is the last week or first week of the quarter. This is the last week, first week of the new quarter. You see, like when money comes in and money goes out? That there's logic and reason to this market. Can you guys see that? Okay, what you're seeing is there's a pattern to a year. There's a normal flow. And that these are just not random periods of time. So, what I had pointed out a week and a half ago, higher high, okay? Remember, I taught you on 2 or 3 different currency pairs again today. I will do this one more time. You have a higher high, you look at the previous higher high, you drag it across. That is your potential buy zone. Bulls have already done it. So they're going to make money or they're going to get knocked out. Retail traders are just, at best, scratching their head. At worst, don't ask. Okay? And an institutional trader thinks it's going to do that, or they're out. They're not interested in being in that trade. I think some traders are short right now, and it's a higher risk trade because they have to take out all the bulls and they got to collapse this market. So what would make that happen? Macroeconomics. It's not your technical analysis. I'm telling you, it's not your technical analysis. Technical analysis is only tells you that it has happened. What matters on this trade? Can you tell me? Can you guys tell me based on what I taught you today? If you only knew what I taught you today, what would be the leading indicator that gold is coming down? What would give you permission to engage to the sell side? But codename Ren, like, so this could be bears faking or taking profit? Yeah. There's something else going on, but you could think of it that way. You could also say gold always goes up this time of year, and that's also somewhat right, but that's not the true story. What's going on this, guys? Type in a question mark if you don't know. No, it's not on a chart. Don't be so amateur. Come on, never stop grinding. A chart? You're kidding me. Bill Ackman, for example, is betting against the peg for the Hong Kong dollar to the US dollar. Why? Because of a chart? No, come on. No, nobody cares about charts. Charts are what you do to execute trades, but not to make decisions. Okay? The terminal rate for the Fed, right? The terminal rate for interest rates. When will the Fed stop raising interest rates? And they're already priced in, like, what was it, March? And if we find out they're wrong, they meaning the market, that the Fed is not going to stop at 5, they're going to go to 5.25 or 5.5. That's not priced in. And if that, if that starts to move, do you remember I was showing you the normal distribution? If that moves the normal distribution to the right because of an increased terminal rate from 5 to 5.25, for example, gold's coming down. And if it's wrong and they price in yet another change, so a couple of months goes by, inflation's not coming down as much, So now we got to go to 5.5 on the terminal rate. Gold comes down more. That's how you make money. TT says, is it the Fed that cannot confirm the rate? They haven't made a decision. This is people analyzing and essentially betting what they think the future is like. They're not betting on the Fed, they're betting on the future. The future of what? Employment. GDP. Right? Inflation. Okay? This is why you need good tools. So that you can say, well, look at the interest rate now, look at unemployment now, look at inflation now, look at GDP now, look at the changes that's going on, comparing the two countries. What's the see? This is a cycle in the market, but we also have a cycle in the economy. You got to know where we are. What's GDP, but what's potential GDP, and where's the cycle? You're going to need to take the macroeconomics course. I'm telling you, take the macroeconomics course. It's an FX boot camp. You got to know that because these are the questions that are being asked. Okay? And right now, what do we see here? Euro dollar's going up, but economically or fundamentally, we'll say it's more likely to go down in the next few months than up. So if this euro dollar rolls over, and I expect that to happen in January, let me bring that back, then I'm going to do very well. Why do I think this is going to come down in January? Anybody want to guess? Well, let's go through this. The economics favor the United States, right? So GDP favors the United States. Inflation favors the United States. Unemployment favors the United States. Interest rates favor the United States. Okay? Check it out. What do we see here? Institutional positioning of money is neutral. And retail is short. Retail's short. So, right now, this is fizzling its way up, likely on profit taking. So right now it's up, maybe because retail's short. Stupid is as stupid does. It's not their fault. They just don't know. But the thing is, check it out. Between January and March, down, baby, down. So when this technically rolls over and this green turns to red, so. But what's the big money? How do you make big money? Big money. Wayne, buy me a Lambo. Well, the trading part's easy, son. It's just knowing when to let it run. And how dare you make 25 pips profit on a trade that's going to fall 250 pips, 500 pips, 1,000 pips? How dare you only pick up 25? The hard work is knowing that you're a bear. The really hard work is sitting in front of your charts and waiting for the right time, waiting for the right price. And that's price and time, that's technical analysis. And then if you shorted this, let's say, we'll pick on this, and you shorted here, for example, I know, right? I know this is gold, but just follow the technicals. Okay, you waited. Took the trade, put the stop here or put the stop here, whatever the case may be. Then it makes a lower low, then it makes a lower high, then it starts to roll over. Okay, it makes a lower low. You move your stop to break even. Now what? You probably have made more than your, 25 pip or whatever the equivalent is. But now what? How do you make big money? How do you go from a Hyundai to a Hydra? How do you go from a Ford to a Ferrari? You let it run. Well, how do you know to let it run? Because you're smarter than everybody else and you're better looking. But the best thing about you is your modesty. Look, you just have a better sense of why the market's moving. Okay? Isn't that wonderful? You got to ask the right questions. And you got to have the right data if you're going to be able to accurately predict the future. So thank you for your time today. I went long. I apologize. Peace on earth. May the pips be with you. May your profits be above average. Cheers.